So, okay, we hear about this inflation going through the roof, right? So everyone's talking about interest rates, and you're like, man, what do interest rates and inflation have to do with each other? Well, I mean, like I said, at this point, you likely know that inflation's been hitting historic highs worldwide, right? In the U.S., a gauge known as the Consumer Price Index, or you might have heard it as the CPI, indicates that consumer prices have risen 9.1% from June of 2021 to June of 2022, the largest 12-month increase in 40 years. Supply shortage fallout from COVID-19 pandemic and higher energy prices, driven in part by, Russia's invasion of Ukraine, right? This has contributed to the, astounding consumer price index rise. Now, many suppliers haven't been able to keep up with consumer demand due to issues, labor shortages, supply chain disruptions, the list goes on and on. And it's not just inflation that's increased, because both inflation and interest rates have moved sharply higher, which that's not a coincidence. So, how does rising inflation affect interest rates? Okay, generally speaking, modern economic theory suggests that inflation is driven by supply and demand. Rising inflation indicates there's more demand than supply for goods and services, which are increasing in price. Now, the Federal Reserve has tools to help control inflation if it's showing signs of persistence. One of these mechanisms is raising the federal funds rate, which is the interest rate that banks charge each other for lending or borrowing reserve balances overnight. Now, this benchmark interest rate directly or indirectly influences other interest rates, including your credit card rate, car loan rate, student loan rate, mortgages, certificates of deposit, your savings account, right? All of these. Now, the Fed's recent interest rate hikes have been directed at curbing the demand side of the supply and demand, interlocking play. Now, the theory is that the higher interest rates will deter some consumers and businesses from spending on homes, cars, remodeling, and these other really large purchases that might require a line of credit or some other form of taking on debt. All right, with higher interest payments, the purchase would be more expensive and therefore less attractive for buyers, slowing down demand. Now, it may take quite a bit of time for the Fed's rate hikes and, anything else that they might do, any other kind of move, right? Reducing security holdings or, whatever it is they might do to actually bring down inflation to its generally acceptable about 2% target, right? That's what they aim for. They're aiming for about 2% interest rate, okay? So, in the meantime, the Fed, they're busy analyzing just mountains of economic data, right? Stuff like trends in prices, wages, consumer expectations about inflation over time, right? And they're going to go over these and just try to determine how much to raise rates and also how frequently to raise them. Are they going to raise it, 0.10, 0.25, 0.5? When are they, how much, are they going to do a 0.5% increase over a year? 0.25% increase over 6 months? Like, what are they going to do? Right? And it's a delicate task, since hiking rates can solve one problem, but cause a bunch of other ones, right? Okay, well, why are rising interest rates an issue? Like, what's the problem there? Okay, because consumer spending represents about 2/3 of the US GDP. Increasing interest rates and thereby reducing consumer spending too much, that's going to contribute to a recession, which is a significant, far reaching decline in economic activity lasting more than a couple months. Now, one historical example that serves as a cautionary tale is the 1981 1982 recession. It was a Not a very good period, right? And during that, the unemployment rate hit about 11%. Now, it came on the heels of inflation peaking at about 11.5% in March of 1980. Now, the CPI was almost 15%, and the Fed boosting the federal funds rate to a record high of 20% months later. Now, the painful medicine of high interest rates worked. Inflation dropped to 5% by October 1982, and then the labor market improved. Even if raising rates doesn't have such dramatic consequences, any intended cooling of economic activity can have negative, repercussions for workers. The International Monetary Fund, for example, right, expects that reduced demand could push the US unemployment rate to about 5% by the end of 2023, which should in turn cause wages to unfortunately fall. Now, climbing rates can have ripple effects on consumers' finances that go way beyond layoffs and just lower wages, right? So consider 30-year fixed mortgages, which aren't directly tied to the federal funds rate, but they generally move in the same direction. Higher mortgage rates could spook potential buyers and lead sellers to reduce the asking price of their homes, which, if you look around now, it's kind of already happening, right? Especially in some markets. Now, other consequences of higher interest rates are more direct, like increasing in the cost of borrowing. Now, there's a good chance your credit card's annual percentage rate could rise following a rate hike, right? The jump may make it even more critical to pay off monthly balances in full to avoid paying interest altogether. Well, of course, there's always negatives, but with negatives, there's always positives. So, positives come from higher interest rates. Okay. While higher interest rates can be costly for borrowers, the opposite may be true for savers. Yields on, certificates of deposit, savings accounts, money market funds, and bonds, these are going to generally rise when the Fed raises interest rates, right? Putting more money into the pockets of savers or investors, right? And make sure if you're an investor, and we say this time and time again, right? Always be putting money in weekly, bi weekly, like every paycheck or monthly, just dollar cost average in. That's your best way, right? So I hope this kind of explains like some of the things of why interest rates and inflation, you always hear those being talked about together, right? And hopefully it doesn't spook you too much now. You get a little bit better understanding of what's going on and the relationship these two share. Hopefully you got some good information out of this. If you did, smash that like button for me. But until I see you guys in the next one, y'all be safe.